Hi, I'm Louise Harvey and I sit in our debt advisory practice at Deloitte and work with financial sponsors, helping them raise acquisition finance to support their investments upon entry, during ownership and at exit. And I'm here to tell you about the 2023 outlook in the capital markets. But let's have a quick look back first. The influx of capital into the private credit market has completely transformed how borrowers finance themselves. As the number of lenders grew, fierce competition has ultimately benefited borrowers. Financing options became more varied, flexible, and bespoke, driving leverage to dizzying heights at the back end of 2021. There has been a focus on financial engineering through subscription lines, NAV facilities, and GP financing, all helping drive strong returns for shareholders. This year has been a tale of two halves, with the first 6 months continuing the trend from last year as lenders deployed record amounts of capital. However, today the market conditions for raising finance is the hardest it's been for a decade. So what's driving market activity? Macroeconomic uncertainty and inflation have led to a rise in interest rates, which has depressed debt capacity by, on average, a turn to a turn and a half of leverage for every borrower. Our hedging team are extremely busy protecting borrowers from rising interest rates by implementing hedging instruments with competitive charges. Given the last 18 months of record deployment, many lenders do not need to do any more this year. There's also a nervousness around fundraising, with limited partners being more considerate about choosing their manager. However, that's not to say there isn't a considerable amount of dry powder out there trying to find a home. But the bar for lending has never been higher, so you can't get away with cutting corners or driving unreasonable and overly aggressive processes. Deals are still being done, both M&A driven and maturity-led refinancing, but it remains tough out there. What can we expect in 2023? We anticipate renewed appetite from lenders for new opportunities. Companies will be more data-rich regarding their past performance and proven ability to sustain increased base rates and inflation. Revised budgets will also be set. Cash and performance improvement activities will be underway, and short-term uncertainty will become more of a long-term reality. Of course, the diligence threshold will remain high, with specific sectors needing to work harder to find liquidity. And while some lenders will continue to try and tighten terms, we're optimistic that conditions will improve for borrowers if they are properly prepared and they'll be able to unlock the huge amount of dry powder out there, rebalance the capital structure, and unlock their growth potential. If you want to discuss how this may impact your organisation, please do get in touch.